As the regular market is currently closed, the latest closing data from the final bell on June 17, 2026 shows Nuburu stock, trading under the ticker symbol BURU on the NYSE American, sitting at exactly $0.168 per share, registering a substantial single-day surge of 14.28% on massive trading volume. While a quick look at common investing sites might lead someone to believe this is just another volatile penny stock experiencing a temporary retail squeeze, the hidden reality is a calculated operational pivot toward international military systems and state-backed defense infrastructure. Most market watchers assume a microcap laser company trading under $1 is merely fighting for survival against burning cash reserves, but the numbers coming out of their recent European regulatory filings suggest a much deeper story that is caught between extreme financial distress and massive projected cash inflows. When you observe traders discussing this on a modern interactive brokers platform or tracking the rapid volume spikes through a retail individual brokerage account, the superficial discussion focuses entirely on the price fluctuations, completely missing the structural shift in the corporate asset base. The basic expectation surrounding this asset has always been that it would remain a niche manufacturer of industrial components, trying to convince automotive giants to adopt specialized manufacturing tools. The reality we are seeing play out is that the management has effectively abandoned the slow-moving commercial manufacturing market to transform the enterprise into a dual-use defense and security platform focused on directed energy weapons and counter-drone systems. This creates an intense friction between what the public thinks they are buying and what the balance sheet actually reflects. When a retail trader opens their Robinhood app or looks for automated investment help through a service like Schwab Intelligent Portfolios, they are looking at historical indicators that show a steep decline from past highs, completely separate from the active geopolitical partnerships being forged in Southern Europe. To understand why 45 million shares suddenly moved in a single session, one has to look past the historical chart and look directly at the legal frameworks governing national security assets overseas. The recent price action is directly tied to a massive regulatory disclosure involving the Italian government and a formal filing known as a Golden Power notification. For context, this is a specialized legal mechanism that Western governments use to review and approve foreign investments in critical national infrastructure, communications, and defense networks. This filing was triggered by the company finalizing its definitive share purchase agreement to acquire a controlling 70% stake in Tecne, an established Italian defense contractor. The newly unveiled business plan submitted directly to European regulators outlines an ambitious target of approximately $336 million in cumulative gross revenue between now and 2029, explicitly focusing on an alliance that completely excludes commercial distribution within the United States. This level of forward visibility is completely unexpected for an entity that generated less than $500,000 in total revenue over the preceding 12 months, completely upending the narrative that has kept the valuation compressed. When retail participants engage in self-investing or browse through the trending sections of prominent investing sites, their focus naturally gravitates toward large familiar names like Tesla stock, Apple stock, or Nvidia stock, where institutional liquidities create predictable trading channels. However, microcap setups like this present an entirely different set of structural mechanics, where institutional activity is defined by debt conversions rather than open market accumulation. The massive volume surge we observed, which far exceeded the historical average daily volume of 27 million shares, indicates that high-frequency systems and speculative pools are repositioning around these defense milestones. For anyone utilizing a Fidelity trading platform or monitoring market depth via interactive brokers trading systems, the sudden influx of liquidity represents a critical inflection point where the company is trying to escape a severe listing compliance trap. The financial reality of the firm has been exceptionally grim, which explains why the broader market has treated it with extreme skepticism until now. The organization has spent quarters facing severe listing compliance challenges on the NYSE American due to a massive deficit in stockholders' equity, which at one point bottomed out at a negative $15 million. It was only during the first quarter reports of this year that they managed to swing back into positive equity territory at $2.17 million, primarily through structured warrant exchanges and restructuring agreements with private investment groups like Indigo. This delicate balancing act on the balance sheet is why conservative wealth managers using Fidelity investments or structuring client portfolios via Fidelity Wealth Management have completely stayed away from the ticker. The inherent risk of a capital shortfall is constant, and the reliance on dilutive financing mechanisms means that even as the business wins major international contracts, the actual value per share can be heavily diluted by the issuance of new equity to satisfy lenders. To fully comprehend the underlying asset, we must look at what the business actually engineered before this defense pivot. The company established its reputation on the development of high-power blue laser systems. Traditional industrial lasers operate in the infrared spectrum, which works well for many materials but faces severe physical limitations when dealing with highly reflective metals. Blue laser light is absorbed by metals like copper, gold, and aluminum at a rate that is up to 20 times higher than infrared light. In practice, this means manufacturing plants can weld critical electronic components and electric vehicle battery packs significantly faster and without creating
creating the structural defects common with older systems. While this sounded incredible on paper, the commercial adoption curve proved to be painfully slow and capital-intensive, leading to the massive net losses that retail investors frequently flag on their SoFi investing dashboards. Recognizing that commercial industrial markets were not providing the rapid cash flow needed to sustain operations, the company began aggressively redirecting its photonics technology toward military applications. This led to the creation of specialized subsidiaries and strategic alliances through their Italian operating unit, Liocon. They signed an agreement with an international firm called SunCubes to build a specialized division targeting directed energy weapons and counter unmanned aerial systems. They are also actively designing blue laser solutions for submarine and underwater environments, attempting to provide wireless power transmission across maritime infrastructure. This is a massive departure from their original business model of selling welding machines to factories, and it highlights how the leadership is trying to capitalize on the rapidly expanding global defense budgets that are dominating macroeconomic discussions. Comment below how many shares of Nuburu you currently hold, or if you are entirely avoiding microcap defense stocks in your portfolio. For the active trader navigating options or looking at execution speeds on a Robinhood stock trading setup, the near-term momentum is heavily dependent on the final clearance of the Italian Golden Power Review. If the Italian government approves the transaction, the company will gain immediate access to an established manufacturing facility in Ortona, which is projected to add over 300 direct jobs by 2030 and act as the primary hub for producing specialized military vehicles, electronic warfare systems, and optical communications hardware. Furthermore, the company has been systematically acquiring full control of a software entity called Orbit, which they intend to position as the cybersecurity and command layer for these integrated weapons platforms. This integration of hardware, software, and optics is a complex puzzle that requires significant execution capability, and any regulatory delay or failure to secure the remaining milestone-based funding would be catastrophic for the current valuation. When evaluating this situation through a sophisticated online investment strategy, you have to look closely at the upcoming corporate catalysts scheduled for the coming months. A critical stockholder vote is slated for late July regarding the preferred shares that will enable the complete transition of Orbit ownership. Following that, the business faces a hard regulatory deadline in late October to fully regain compliance with the NYSE American listing standards. This means management is under intense pressure to maintain a stable market value and improve their asset-to-liability ratios rapidly. If you are analyzing this setup on a SoFi active investing app or utilizing advanced screening tools on a Fidelity brokerage account, these regulatory deadlines should take priority over any generic technical analysis patterns on the daily chart. The future outlook for this ticker presents two completely different scenarios that tie back to our core theme of expectation versus reality. The bullish expectation is that the consolidation of European defense revenues will instantly validate the company's valuation, driving the stock price out of the penny market as hundreds of millions of pro rata revenue flow onto the income statement. The reality, however, is bounded by a highly complex capital structure, including a massive $25 million unsecured debenture that matures in December of this year. Refinancing or converting that level of debt when your market capitalization is sitting under $30 million is an incredibly difficult hurdle that frequently results in massive equity restructuring at the expense of existing retail holders who bought in during high-volume rallies. Ultimately, the contrast between market perception and operational execution here is as stark as it gets. The broader investing public often views these low-price tickers through the lens of pure gambling, comparing them to rapid meme movements or speculative crypto swings on a Robinhood crypto feed. Yet the actual filings reveal an intricate web of international corporate governance, sovereign regulatory reviews, and advanced photonics manufacturing that resembles a high-stakes corporate restructuring project. Whether the company successfully bridges the gap between its current severe cash constraints and its massive projected 2029 defense revenues depends entirely on smooth regulatory approvals and tight cost controls over the next 2 quarters. The dramatic 14% move we just witnessed is simply the market beginning to register that this is no longer just a struggling industrial laser shop, but a highly speculative defense asset whose survival hinges on European military spending. Disclaimer: this video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before making any investment decisions. Invest responsibly. Buy, comment, and share this video to support the channel.